is I had a client, again, a single mum. She had 3 kids, and her 5-year-old was playing with matches and set the house on fire, and the kitchen was completely burnt out. So she used her credit cards to have the kitchen rebuilt. A year down the track, she was really struggling paying those credit cards. And those credit cards were with a major bank. I won't say who it is. So we negotiated with those credit cards, and we reduced the $38,000 down to about $6,000 or $7,000. But she had to raise $7,000, and you know where she got that $7,000 from? It was from the same bank we were negotiating with, but she got a personal loan with them, and that personal loan paid out that same bank the settlement because it's siloed. One hand didn't know what the other hand was doing. Now, is every bank like that? Every financial institution is like that? Probably not. So it's hit and miss.
Welcome to the Debt to Financial Freedom podcast. I'm your host, Victor Lagos, and the founder of Lagos Financial. I've been in the finance and lending industry for 16 years, and I've personally made financial mistakes and learned from them. I started this podcast to share stories and lessons on my own journey and to share insights that may help others on their journey. And I interview people that I've connected with that share the same values and mission to help others create financial freedom. Welcome to the Debt to Financial Freedom podcast. I'm your host, Victor Lagos. I am also the founder of Lagos Financial, a residential and commercial finance brokerage, and the co-founder of a new business called Propeller, which is a property investment strategy consultancy. Today, I have a guest. His name is Laurence Hugo, and I'll let him do an intro, but I wanted to give a bit of background. His expertise lies in debt negotiation, specifically unsecured debts. And I've got a bit of experience in this field. Another lifetime ago, I used to do what's called Part 9 debt agreements for a living. And it's a part of the story that I haven't really shared on previous episodes, but I think it's an important part of the journey because, the podcast is called Debt to Financial Freedom for a reason. A lot of people are in debt and a lot of people are in bad debt. And we're all on a journey to figure out how do we get to financial freedom. And a lot of my clients in the latest years have been investors, people that are already in that journey on the higher end of the spectrum. And I've always had that intent to help people on that lower end, the ones that are in a bit of trouble, because I've been there before. And another part of that story is my mum has actually been in that position where she had over $100,000 worth of credit card debt at one point. And I actually did meet someone who negotiated her debts in 2015. She had 5 different credit cards, and she was able to negotiate her credit card debts from $100,000 down to $20,000. And I couldn't believe it, right? It was different creditors, different banks, and they all agreed. But it meant that we had to come up with the money within 7 days. But that was a massive relief for her because she had collection agencies calling her. She was nearly having a nervous breakdown. And on top of that, she was keeping it a secret from my father, which many listeners out there understand that, when it comes to the emotions we have around money and debt, sometimes we keep that to ourselves and we don't share that with the people that matter to us the most. And that can cause, some marriage breakdowns, family breakdowns. And I think, and even worse, it can cause suicide. And Laurence, I think you've got some experience, not just in the debt side, but also helping people who are in that dark place in their life. So welcome to the show. And tell us a little bit about yourself.
Thanks, Victor. Thanks for your welcome to your show, and it's a great podcast because the kind of information that you're offering to the community is, frankly, it's quite invaluable because one of the missing links, if you like, in our community is financial education. And if we're educated around how it is that we need to invest our money and spend our money, then we're all the better for it. And I know you're all about that. So thanks for that. So again, thanks for the invite on the podcast. Now, you mentioned before that it's a journey, and I think that that's a really great way to describe our life in the sense where we make these financial mistakes, we go through that journey, we learn from that, and we pay our debts, and then we invest. That's a new journey, it's new lessons. We start investing, and we might make mistakes, and we might score some goals, and that's a journey. And what the journey is about, it's about the experience as well as the destination, and learning the lessons. And that way, the destination is coloured in the right way for us. We arrive in the right place in our destination, so long as we're learning from the lessons and from the mistakes that we're making along the way. And I'm the one that makes so many mistakes in so many different ways. But the difference for many people is if we learn from those mistakes, then we're not making them tomorrow. So you're talking with me because I'm a debt negotiator, and we're the first debt negotiation house in the country. So we've been running for 25 years, and we've saved upwards of $110 million for consumers and companies over that period of time. Now, we've been working for a long time. We've worked with all the debt collection agencies, all the banks, major and minor, financial institutions. We've got a lot of experience in negotiating with these agencies for lowered payout figures. For example, the great experience you had with that debt negotiator, or that your mum had from 15 years ago, and from $100,000 down to $20,000. It's a very good outcome. So they did very well.
So I want to, for the listeners who don't know what debt negotiation actually is, or maybe they don't even realize that this is an industry, how did it really come about? Because I mentioned Part 9 debt agreements, and that's one form of negotiation, but that affects your credit file. It falls under the Bankruptcy Act. But what you do is totally different. Can you explain it a little bit, I guess, about what the industry is? You were a pioneer in the industry and how it's sort of grown.
Yeah, it's a good question, and it's the Part 9s, Part 10s. That's been part of the Bankruptcy Act for some time. PIAs, and that's a different stream. With the debt negotiations, it's evolved over the years. Now, I remember back in 1988, 89, working for an American finance company, Household Financial Solutions, Household Financial Services in Sydney, and just answering your question, I'll get a letter on my desk, and I worked in debt collections. I'll get a letter on my desk from a solicitor, and the top of the letter is torn off, just the top corner part. So there was a check attached to it, but it's gone. But the mailing office had taken the check off, and they processed the check. And on this letter is a declaration: if you cash this check, then you rescind any claim on my client for any further obligation, or words to that effect. So the check will be, say, $10 or $100, and the client will owe $3,000 or $5,000 or $10,000. And the lawyer would state, if you cash that check, then you're legally obligated to accept that as a full and final settlement. Now, that didn't last long because it was challenged, and it doesn't stand up in court. But this is sort of where debt negotiation kind of started, with the unscrupulous players trying to get the best deal for their clients using various methods. There are other solicitors who would try to negotiate, some successfully, some not successfully, using more ethical processes. The problem with this is that they're lawyers, or they're accountants, or they're counsellors, or they're whatever. It's not their area of expertise. You go to a lawyer to do law. You go to an accountant to do accounting. You go to a counsellor to do counselling. You use a builder to build a house, not to do your electricity, right? So they were the first clumsy attempts around the debt negotiation industry. How the industry started, it started around 2 a.m. 2001. In January, around January 15, 2001, about 2 a.m., in its form that we see today. Now, I used to be a Lifeline counsellor, and it was a midnight shift. And it was 2 a.m. and I pick up a phone call and it's a suicide. Now, during the day, my job was to foreclose on properties. That was my job with the bank. And every fortnight I'd have a shift with Lifeline, and I pick up this phone, and it's a fairly young man, about your age. He had a couple of kids, lived in an apartment with his wife in Sydney, and he received a foreclosure notice. And he was going to take his life by jumping off the balcony. Now, that call, it ended up quite successful. So we resolved as best we could in that phone call, and we intervened. But one of the things that I reflected on that call is, what am I doing here? So on one side, I'm a debt collector. On the other side, I'm moonlighting as a counsellor, dealing with the results of my actions as a debt collector. So there's got to be a way to bring the two together. And the debt negotiation industry was born. And how that was born was that we started a business, the business and the industry in its infancy. We started this business offering people who are experiencing financial hardship a way they can trade through. So a way they can deal with a mortgage and the mortgage arrears, a way they can deal with the unsecured creditors, the credit cards, personal loans, and that sort of thing, by negotiating and reducing the balances. And that's how it started.
I'm actually curious to understand a little bit more around what you do end up negotiating, because I mentioned earlier that when my mum, or this debt negotiation company, negotiated the credit cards for my mum, that meant that final payment was due within 7 days. And fortunately, I had access to cash at the time because I had access to some equity from a property that I owned. But for people out there that don't have access to capital, does that mean you then negotiate some type of payment plan, something that's more affordable for them? Do you go into their bank statements and understand what can they actually afford to pay based on their current circumstances?
Right. Interesting question. So, the industry has evolved and it's become a lot more sophisticated. So these days, you can have an arrangement where you pay 20 cents on the dollar, 1 cent on the dollar, 60 cents on the dollar within 7 days, or 30 days, or 60 days, depending on the scenario. So that's on the settlement option. But then you have an interest-free payment plan option. Excuse me. So about 7-8 years ago, we observed an explosion of Part 9s. You mentioned Part 9, that you're working in the Part 9 industry before. There's an explosion of these debt agreements, and which is a great service if it's appropriate for the consumer. But one of the negative sides to the Part 9s is a bankruptcy listing on their credit report, which will sit there for 5 years. And so that kind of leaves a sort of a sour taste in some consumers' mouths because they want to move on with their, with borrowing in the future. And so what we did is we created a new product. And about 8 years ago, it took about a year for us to convince the banks to do this. And that is interest-free payment plan. I call it a Clayton's Part 9 because it's a Part 9 you're having when you're not having a Part 9. And if you're over 50, you'll know what that means. So essentially, if you owe $100,000 on credit cards, your monthly repayments will be about $3,000 a month, right? Approximately. And if, like most people, you're on that level with credit cards, it's no longer a credit card where you're paying down and paying out to zero every single month. Rather, it's been treated like a personal loan. You're just paying them in monthly due payments. So basically, over the period of 20 years, you're going to be paying back $200,000, $300,000 in interest, right? So with the interest-free payment plan, what we do is we reduce the $100,000 down to about, say, $70,000, and you pay that off over, say, 7 years, interest-free at about $830 a month. All right. So what we do and what other negotiators have slowly been picking up and taking on as well is you reduce the monthly payments by half to 2/3. It's a permanent interest block, and you're paying your debt off over 7 years, not 27 years. But the kicker is you don't have to pay all that future interest. And that is a huge benefit for a family who's struggling.
And would you say, since we've had a lot of interest rate rises and inflation in the last couple of years, there's been an uptick in the customers and people that actually need this service right now?
Yeah, most certainly. But it's not a sudden uptick. It's not a sudden uptick, Victor, because you know that you're running along fine, and suddenly you're moving from a fixed to a variable rate, or if you're on a variable, it's bumped up by 0.2% and another 0.25% and so on, and you're the frog slowly, in the pot slowly boiling, but you're not quite aware, uh, that things are heating up, and so usually what we find in these kinds of environments, it's the after effect. This is at the time when you've had the increase of the interest rates. People don't necessarily seek assistance at that time, although they do. But we find that it's afterwards when they feel the pain and the consequences of the increase of the rates. So, for example, if you move from a fixed to variable, you're paying like 7%, and your monthly payments are doubled or tripled. Suddenly, you're in a lot of pain, and so you get credit cards to pay the mortgage, and you're getting mum and dad to help pay the mortgage. You rent a room out to a boarder. You're working a second job, and we find that a lot of people are doing that and not calling on professional assistance until it gets to the point where I can't pay this month's mortgage and it's 30 days in arrears. And so they might seek assistance. We saw that especially with COVID. With COVID, we anticipated a rush into our business, but we saw actually a drop in business. And even the insolvency industry saw a drop in the business. Because consumers and families and companies were getting government assistance and creating an artificial financial environment propping them up. And then when that artificial assistance disappeared, suddenly a lot of people fell down. And there's a spike in company insolvencies. There's a spike in arrears events, non-performing loans with the banks, which is doubling. And so now that they're feeling the pain, i.e. arrears notices, foreclosure notices, and so on, there's a rush to seek assistance from financial counsellors, debt negotiators, lawyers, and so on and so forth, who may be able to help them. So yes, to answer your question, he's getting busy.
Yeah, and I guess what I want to understand, and probably the listeners would like to know, is that when is actually an appropriate time to contact your company, for example? Because I just want to add on this in that people put their head in the sand, right? Or like you said, they cash advance on the credit card. I know some even go to like cash converters and pawn shops and hock their jewelry. People do anything, whatever they can to kind of stay on top of their payments, especially the mortgage, right? Because this is the shelter, this is their home where they live.
Right.
And also, I think that a lot of people have known that publicly they were saying they predicted that property prices would drop through COVID, but instead we had a boom. So now everyone's kind of thinking, wait, I don't want to sell because I want to pick up on the next boom and I want to make money. I don't want to lose and sell. So they kind of hold on for dear life and do whatever they can. But that's at the cost of their basically their whole lifestyle and their safety and how they live, and they're in a survival state. So I guess the question again is like, when is an appropriate time to approach a debt negotiator? Do they need to be at collection stage? Do they need to be at a point where they're having to cash advance on credit cards or borrow money from family? Or is it a point where they just realize that, wait a minute, I'm only living off of, eating noodles every night or whatever it is. And I'm only living off, say, 20% of my net income, and the rest of it's going to bills. That's...
Well, the quick answer to your question is yesterday. The long answer is contact a specialist to get advice, because everyone you speak to has a financial interest in a relationship with you, right? Whether it's a mortgage broker or a debt collector or the bank or a debt negotiator, everyone has, except for your mum and dad, have a financial interest in dialoguing with you. And if you find a good mortgage broker like yourself, who, sure, we make a buck in writing deals, but that's our job. But you're my customer, and I've got to look after you. And so, if you're lucky enough and blessed enough to engage with someone who has a vested interest in doing their absolute best for you, then you hang on to them. It's like having a good mechanic and a good electrician. You got them, you hang on to them, right? So the first thing is you've got to deal with it as soon as possible. Second is you've got to critically assess the specialists that you're dealing with to ensure that you're dealing with the right person, all right? Or are they going to give you a quick, easy, tasteless service like McDonald's? Are they going to give you a fast food response where it's just running it by numbers, right? So you've got to assess that firstly. When you're eating noodles for dinner, that's when you know you've got a problem. So about 50% of our clients, their credit reports look like Christmas trees. They've got arrears events all over their credit report, defaults. The debt collection agencies are chasing them, and how we deal with a scenario like that will be different compared to how we'll deal with the other 50% of our clients who are up to date, right? So many of our clients are paying their mortgage up to date. They're paying their credit cards up to date, clean as a whistle, but literally they're eating noodles for dinner. I remember I was talking with a single mum. She had 2 kids, and she worked a full-time job. And how you work a full-time job as a single mum with 2 kids, I don't know how you do that just on its own, with not to mention the added pressure of financial hardship. But I asked her, we went going through her budget, and she was spending $60 a week on food between the 3 of them. How are you spending $60? How is that? How are you doing that? And she said, well, pasta and rice goes a long way. Right. And yet she was keeping her credit card payments up to date. No. So when you're feeling the pinch, that's the time to contact a debt negotiator, because one day one of your kids are going to need braces. One of your kids is going to spend overnight in hospital because they've broken their arm, and a bill will come in and you can't pay it. So right now is the time.
So another thing that just you reminded me of is, when circumstances can change, right? No one's situation is the same forever. Income can go up and income can go down, right? Someone can be out of a job. You have an unplanned kid, death in the family. There's so many different, variables that can put you under pressure. And I think people remember the good times, and they feel that they want everything to be temporary, and then they want to protect their credit history. And I know that because I've been in that position where I wanted to protect my credit history because I know that it's temporary, and then I'm going to get in a better position. And when I want to buy property, I'm presenting the best possible light to the banks. So I guess the question I have, something I want to mention, is that when you negotiate the debts, it doesn't mean your credit file is impacted. It's actually the contrary. You actually get to protect your credit file and get your payments to an affordable level, and
That's
basically
right.
reduce that debt and no longer pay interest on it. So it's actually win-win-win scenario, right? So can you sort of elaborate on that a little bit?
Yeah, and that's a really good point, Victor, that you bring up, because like in different things, for me, I often leave things to the last minute, right? When it comes to packing for a trip or something else, and then I'll make mistakes and I'll forget things. And when it comes to financial matters, a lot of people are like that too, where they just leave it to the last minute. And if you leave things to the last minute, then it could be troublesome for your credit report. What caught a lot of people out from 2-3 years ago with the CCR reporting, banks are required to list you as an arrears event if you're 2+ weeks in arrears. So if you miss your mortgage payment because you forgot, or you're traveling overseas and you asked your brother to pay the mortgage payment for you and he forgets or whatever, then that leaves a negative reporting mark on your credit report, and that can be extremely detrimental for you in securing a refinance at a later point. So, it's critical to ensure that whatever decision you're going to make, if you're experiencing the sting of financial hardship, is to consider, if I take this next step, what's the impact on my credit report? It's a critical question. And whoever you speak to, in whatever service they provide, it's a question that must be asked. Okay. Now, if they have a license, they ought to have a license. If they're playing in the finance sandbox, then they're obligated to disclose all that information to you, as you know, Victor. So, in terms of debt negotiations, there's no negative impact on the consumer's credit report. So there wouldn't be a default, there wouldn't be an arrears event. And sometimes what happens in negotiations, banks get a bit slack and they might list an arrears event because their software has done it. And because they're just on automatic pilot, as you know, with big banks. And so the negotiator ought to then go back and say, hey, you've listed an arrears event whilst we've had this client's file in hardship. Can you please remove it? In fact, that's just happened to us this week with Citibank. And we had an application for financial hardship. It was successful. We got most of the debt waived for the consumer. Yet Citibank listed the consumer mistakenly as an arrears event. And so that was taken care of. You want to avoid if you fall behind with your repayments, you will be listed as an arrears event. Okay. Usually the banks will list around about 3 weeks in arrears. They tend not to do it about 2 weeks. They tend to do it about 2.5 to 3 weeks from that period, particularly with Westpac and St. George. So if you fall behind, that's what's going to happen, and it cannot be removed at all unless there's an application for financial hardship and they did it by mistake. That's when it can be removed, if it's placed there by mistake. When you're using a negotiator, the only listing on your credit report is a hardship listing, and that has no detrimental effect on your credit score. Your credit score will not go down. It'll stay quite high despite the hardship listing, and that hardship listing will drop off after 12 months. Now, if a consumer is sensitive about that, we say, well, then don't negotiate, right? And it's very rare they'll say, no, we're not going to negotiate because, all right, so I'm going to reduce 100,000 down to 20,000, right? Or, and that's great, and I'll have a hardship listing, which will drop off after 12 months, which is not detrimental to my credit score. Or I'll just pay off 100,000 and avoid that hardship listing. So the choice is obvious. You're going to want to save that $80,000, and who cares about a hardship listing on the credit report? It's going to drop off after 12 months, so it's all good. So to answer your question, using a negotiator, it has no detrimental effect on your credit report, but with caution. Keep an eye on your credit report and make sure you question the negotiator to ensure that side is being taken care of and they're aware of it.
Okay. Yeah, you made some really good points there. And I want to add to that as well, because when I set up my first company in 2016, I took out a startup business loan, and it was an overdraft with ANZ. And I also took out a business credit card. Not that I applied for it, but as you know, banks like to offer you more products. Yep. And I did max it out. I believe it was a $16,000 limit. And circumstances changed. I had to actually wind that company down. But the thing that I did was I communicated with ANZ before I got into arrears. And that's the thing I always tell clients. They always ask, especially when they're buying commercial property and they're worried that it's not going to have a lease or a tenant renewal. So I say it's all about communicating with the bank. Right?
You're
At the
right.
end of the day, you just got to tell them what's going on and give them they'll give you some breathing room, right? If it's temporary, like in my circumstance, I asked for, reduced payments, right? For, I think it was 3 months. And I stuck to that. I made those reduced payments. And then I ended up deciding to sell a property to clear this debt that I had. So therefore, I was in a position to negotiate that debt. Yes, I could have paid off the whole amount, but then that would have left me less money to pay towards
Right.
capital gains tax and other expenses. But because I already started that communication, when I approached them and said, look, instead of paying you back the 16 grand, and just so you know, they froze the interest on it as well when I was in that hardship period. I believe from memory, it was like 8 grand, right? They halved the debt and I had to pay it off in 5 days. And I had the cash from the sale and I cleared it and there was no detrimental effect to my credit file. But in saying that, I've never applied for a loan with ANZ since. I don't know if they're going to bring that up from that long ago. And I got to ask you, I guess, Laurence, you mentioned hardship will stay on the credit file for 12 months, but will that create a negative imprint with that bank for the foreseeable future if you've negotiated your debts or if you've gone into financial hardship?
Yeah, that's a really, really good question. If there's any reason not to use a debt negotiator, that's the reason, all right, if you're so inclined. So let's say we negotiate with Westpac and we reduce $10,000 down to $2,000, you pay your $2,000 and it's done, right? And they waive the $8,000. The very next day, you go into a Westpac branch and say, I'd like to apply for a $10,000 credit card, thank you. They're going to say, no, thank you. That's not how it works, and that's a perfectly reasonable response. So the idea is that because the banks don't want you to take advantage of the situation, but they're reasonable people, with the odd exception, and I'll get to that in a second. So if I negotiate with Westpac, reduce the payout figures, and it's done, the dust settles on it. 6, 12, 24 months later, my financial position vastly improves, and I put in an application for finance. They'll assess on the basis of that application. They will raise an eyebrow on the past hardship application, but generally it's a non-issue for most banks and financial institutions. They'll assess on the merits on the moment and your credit report, and they'll make a decision. The one exception I will say is ANZ. And you can't, they have long memories. I was talking to a debt negotiator. I won't say who she is, but she's very, very experienced and she's very good. And she, when she was 22, she applied for financial hardship with ANZ Bank and got most of the debt waived and moved on with her life. She applied for a loan about 4 years ago, applied for a mortgage. So generally, if you go back to the bank that you negotiate with an improved financial position, 6, 12, 24 months later, it should be okay. The only exception is ANZ Bank. A colleague of mine, she had her debt waived when she was 22 with ANZ. It was a small credit card. She's a professional negotiator as well. And she then applied for a mortgage, and that was 25 years ago. She applied for a mortgage about 4 years ago with ANZ. They knocked her back for that reason. Even though she was a very strong financial application, they knocked her back for that reason. That's very unusual in the banking community. So generally it's okay, but ANZ have long memories.
Pretty strict, yeah. Would you say they're the same with consumer and commercial? What I mean by that is I had a mortgage broker who's been listening to my podcast, and he asked me that exact question. He said, client had a default previously with ANZ, and it's dropped off his credit file. He's in a much better position, but now he wants to apply for a business loan with another part of the bank because that default was on the consumer side. I'm curious if that also is going to flag or if it won't pick up at all. Do you know about that?
There's no hard and fast rule around that because banks are highly siloed.
They are.
right? And what the business side does compared to the consumer side, there might not be situation awareness.
Yeah.
And with a lot of mergers with banks, they're still working off two different systems like NAB and Citibank, for example. Look, I mean, we had a consumer example is I had a client, again, a single mum. She had three kids, and her 5-year-old was playing with matches and set the house on fire, and the kitchen was completely burnt out. So she used her credit cards to have the kitchen rebuilt. A year down the track, she was really struggling paying those credit cards. And those credit cards were with a major bank. I won't say who it is. So we negotiated with those credit cards, and we reduced the $38,000 down to about $6,000 or $7,000. But she had to raise $7,000, and you know where she got that $7,000 from? It was from the same bank we were negotiating with, but she got a personal loan with them.
Oh,
And that personal loan paid out that same bank the settlement because it's siloed.
interesting.
One hand didn't know what the other hand was doing. Now, is every bank like that? Every financial institution is like that? Probably not. So it's hit and miss.
Okay.
So the rule of thumb is that if you've had a hardship or a negotiated outcome with a bank today, leave them alone for 6 to 12 months.
Okay.
And build your financial position up. Otherwise, the alternative is just go to another bank. There's 40 or 50 banks out there.
Yeah.
Just simply go to another bank.
Well, that's why I didn't go back to ANZ. But to be honest with you, it's not like I needed them. Anyway, I've been to Macquarie, I've been to CBA, but it's always good to know this for people out there that are worried that they're going to, shoot themselves in the foot for future borrowing, especially if they know that the situation they're in is temporary. Well, not say temporary, like they don't see the change coming, but they know that they will get in a better position at some point, right? Whether the partner is going to get a job again, or they're starting up a business, will take time to get clients, etc. So the other question I have, and I'm sure the listeners, sorry, go on.
Yeah, well, it's a good point, Victor. And I guess I want to add is that for most consumers, it's a non-factor because I owe $100,000 and it's going to sink me. I'm going to lose my house, and if I never have to deal with ANZ again, I don't care. I'll just go to Westpac.
Yeah, that's true.
It's a non-issue. So the bigger issue is dealing with the immediate crisis.
Okay.
Yeah.
So
it's a great question.
You mentioned about losing my house. So I'm sure some of the listeners will be thinking, I've got a mortgage and I've got equity, right? And I've also got all these other debts, but I can't get a loan right now because, interest rates are so high, borrowing capacity has been reduced. So I can't even consolidate my debts, even if I want to. Or maybe a mortgage broker has told me in order for me to get a loan to consolidate my personal loans and credit cards, it's going to be, 2-3% higher interest rate than I'm currently on the home loan. So it's going to increase all of my loan, not just let me keep a lower rate on the majority of the home loan and a high rate on the other debt. So if they then negotiate on their unsecured stuff, the credit cards, personal loans, etc., does that mean their home is protected and they don't have to sell it and they don't have to take out a second mortgage or anything like that, where they're putting themselves at risk of losing the home?
Right. There's so many different directions you can go with that question. Gosh, that's a really good question. I think, firstly, when you have debt, your assets are exposed. Right. So unless there's zero equity, your property is exposed. It's particularly exposed if you cannot afford to pay those debts. Now, generally, the banks, the Westpac's, ANZ, Commonwealth Bank's collection departments generally don't litigate. I'm talking about credit cards, personal loans, unsecured debt. They generally won't litigate to take property. They won't do that, generally, right? The debt goes through a collection process until it's about 6 to 8 months in arrears. Then they outsource it to a debt collection agency. And the debt collection agency, that's their job. So So if I've got a credit card that's 30 days in arrears today and I stop paying indefinitely, it's not going to impact my property until a year or 2 years down the track. Right? My credit report will look like a Christmas tree, and I'll get letters and text messages and phone calls, but a detrimental effect on my property is not going to happen for some time yet down the track. Coming back to, but it's important to note that you don't want to test that because it could happen sooner as well. So it's very important to pay your debts and keep them up to date as best you can, or talk to a specialist. Coming back to the other part of your question, with refinancing. So the question I would have to, if I've got 100 grand in credit cards, I've got equity in my property. What I need to figure out is what's the best financial outcome for me on balance. So there's going to be pros and cons on every single direction I go in. There's going to be a cost that I have to pay, but there's going to be a benefit. So which decision do I take that's going to have the maximize my benefit and minimize my costs? And invariably, but not always, invariably it's refinancing. So if I've got, a fair amount of equity in my property, I'm paying 20% interest on my credit cards at $100,000, and where the property rate is 6%, 7%, whatever the figure is, and that 100,000 is going to be reduced down to, let's call it 20,000 because we keep using that example. I'm going to save myself $80,000 within a few weeks of negotiations. That's pretty good. And then that 20,000 that I pay won't be on 20%. It'll be on 7% on my mortgage rate. Let's refi this sucker. Let's refinance it, because I am going to make an absolute mozza by doing that, even if I go to a second tier lender temporarily. But that's more of a broker question than a negotiator question. So if I pay even like a slightly higher rate going to a second tier lender, then that still might be worth it for me if there's a strategy in place. Yeah. If I work with a broker like yourself. So by dealing with those debts, it's a good thing.
But that
and got to ask the right questions to minimize the risk.
That scenario you just gave, though, 100,000 down to 20 and refinancing. Are you saying that we can do the two strategies at the same time? So essentially, negotiate on the unsecured and apply for a refinance and debt consolidation. But instead of consolidating the full 100, you're only consolidating the 20 because you're negotiating and saying, I will pay out that 80, that 100, and I will negotiate to 20, but I'll pay it out in the next 60 days because I'm applying for a loan to do that. Is that what you're saying?
Exactly right.
Wow.
So you would you wouldn't rely on the negotiator to access a mortgage product for you. The reason being is the negotiator will know about mortgages, but again, you're asking the builder to do the electricity and so on. You want a professional mortgage broker like yourself, been in the industry a long time. You're ethical, and you've got the contacts and you've got the panel of lenders which offer all the variables, all the different products to cater for whatever variables that your client is experiencing, to pick just the right lender and then just the right product under that lender. And so you speak to the broker, so you work with the broker hand in hand with the negotiator. And there might be another specialist who might come in, like a credit repair specialist, who will remove the default. So there's strategies. So you might have 2 or 3 specialists walking together and pacing their work in accordance with each other to get to the end point together of the refinance. And the end point is most of that debt's waived, and you've got a killer mortgage product that's going to save you an absolute fortune, and you're in a much better financial position if you use these specialists.
Yeah, no, really, I love that approach actually, and you're making my mind think, because everything I do for clients is strategic, and I'm thinking about how that could be positioned to a bank, and I do believe that this could actually work well not necessarily go to a second tier. You can actually go to a bank and apply for a loan that's enough. That's assuming the negotiation is accepted. Of course, you'd have to actually, time it well. Like you said, you're sort of working in unison to an extent and communicating, and that's what it's all about. Is just everyone being on the same page, working towards the same objective. And at the end of the day, the client is the one that's benefiting the most. But like anything, everyone has a profession. Everyone's got to make a living for what they do. It's just about charging fairly for the time and expertise for what you do. As a broker, I'm in a unique position because my company gets paid from the banks, a commission, and also a trailing commission. For residential lending, it doesn't affect the interest rate because of what's called best interest duty. So I don't have the ability to request the commission to be dialed down in order to give the client a better interest rate. Commercial, you can, and the fees are different the way I'm remunerated for commercial. But under Consumer Credit, NCCP, National Consumer Credit Protection Act, and best interest duty, it means that clients can actually get the best product rates and fees while my company still gets paid. And it's not out of their pocket that's covering it or a direct correlation with the interest that they're paying. But in terms of debt negotiation, you're talking to people that obviously have got limited access to capital and affordability. So how do you guys actually get paid? Or is this the same for all debt negotiators?
Well, sometimes we don't. It's an interesting question. Okay. 30% of our business is pro bono. So we deal a lot with the terminally ill, and they'll get the full force of our not a watered down version, but the full force of our service. And invariably we'll get all their debts waived, no problems, because of the medical condition. That aside, we charge a fee only on success. This is one of the questions, as I was mentioning before, you're asking questions of the financial specialist. And one of the questions is, what's your fee? And if the negotiator is going to charge upfront, that doesn't mean that they're not going to deliver a good outcome for you, but it potentially is a warning bell, because if you're getting paid upfront, you're not going to put in the best service, potentially. Some negotiators will charge on the back end only on success. Okay, so they have a financial interest in completing the job and to the satisfaction of the consumer. So we charge 22% of what we save, right? And so the more we save, the more money we make, and the more money the customer makes. So that works well. We put our money where our mouth is. Additionally, if the customer is not happy with the outcome, then they have a right to not go ahead with the settlement, and we forfeit our fee. And that's really important, because you as a broker, it's the 11th hour before settlement, and the customer says, I don't want to go ahead with this because of X reason. My plans have changed. I've had a death in the family. I found another deal, whatever. But they have a right to pull back, and they certainly have a right with us. So what if we reduce $100,000 down to $90,000? And the customer can't pay $90,000. They weren't expecting that. They shouldn't be expected to pay our fee of $2,200, 22% of $10,000 saving. They shouldn't be expected to pay that. So the deal is, we deliver. Are you happy? Great. Here's our invoice. Not happy? Okay, that's fine. We forfeit our fee, and you forfeit the savings of fruit of the labour, and everyone goes home, and that's perfectly fine. It rarely happens, but sometimes circumstances change. So the fee for us, 22% of what we save. Sometimes we reduce it to 10 or 5 or 1%, because what if we saved a client a few months ago $6 million in business debt, so we had all that money waived, and so our fee wouldn't be 22% of 6 million. Otherwise, I wouldn't be here. I'll be on some island somewhere taking a long holiday. So it's obviously the fee would reflect the amount of work that's and the savings that's involved.
Yeah, like I said earlier, it's about the getting paid fairly for the time and expertise that you bring. So the commission part is always a challenge, right? There's been a bit of spotlights on mortgage brokers recently saying that they earn a certain amount, and I don't think that the system is perfect personally. The way I get around that for myself is that I make sure I always add value for my clients and try to put them in a better financial position, because at the end of the day, the structure is set up where brokers can be incentivized for people to take on more and more debt and get paid more. But that, to me, that's counterintuitive. If you're offering a service and you're service based and you're wanting to do the right thing by your clients, then you want them to get out of debt. Doesn't matter if it affects your back pocket, right? Get them out of debt, because they'll
Yeah,
stick
you're
with
right.
you, and then they'll refer their friends and their family. So you become the trusted advisor.
It really is a critical point you bring up there, Victor. I was talking last week. I was talking to an older gentleman. He was in his late 60s, and he said, and I said to him, "Look, we can save X amount for you, no problems." And he said, "Well, do you think you can save more? Because I've been with that bank since I was 12 years old, and surely that loyalty will mean something." And I said, "Mate, not anymore." And this is the critical point that you're making, is that when you're dealing with a broker, you're getting a personalized service. When you're dealing, if you go into the branch, you might get the same rate, but you will not get the personalized service. You walk into, and this is not anything against Westpac, for example, but you walk into a Westpac branch, and I bank with Westpac, and I think they're a great bank for many reasons. But if I go into a Westpac branch, I wouldn't buy a mortgage off them. I wouldn't get a mortgage off them directly with the branch. I'd go to a mortgage broker, and I have a mortgage broker to do my mortgages for me. Why? Because the mortgage broker is the aggregate, is the central piece who's got access to all these amazing products, not just with Westpac, but with Commonwealth Bank and with Judo Bank and with lenders especially like Macquarie Leasing. Everything you need for vehicles, equipment, business lending, consumer lending. This broker is an aggregate. You, Victor, you're an aggregate for all these amazing lending, but I'll only get a snapshot of that. If you can picture a pie chart, a snapshot of that if I walk into a Commonwealth Bank branch or an ANZ branch. Only so you're not going to get the best the best level
Comparison.
of access to all these different products, and you're not going to get a personalized service.
Yeah.
And it's the same with everything in financial services. You want someone who has a financial interest in delivering the best possible deal for you. And
Yeah.
generally, banks don't.
It's true. Yeah. Yeah. And another thing is, bankers, a lot of bankers are actually becoming brokers, right? Like, and Commonwealth Bank
Yeah.
has actually increased their bonus structure to try to retain their best bankers, because they're all going out there becoming mortgage brokers. And
Yep.
it's because what happens is you build a relationship with someone at the branch, and they're your go-to. Maybe from time to time you contact them, but then they get promoted or they get another job and they switch banks, and now you get someone new, and it's no longer the same person, and they're new to the industry. They don't understand your situation. You have to explain things all over again. Whereas as a broker, especially a broker like myself that's been in the industry for 18 years, I'm not going anywhere. So I'll always be
That's
around in
right.
this industry. So and I'm upskilling. So then
That's
I'll be
right.
able to then provide other options, like I am at the moment with commercial property and other investment strategies. So it's like that's always adding to my artillery of services that I can help my clients with, because you know
And yeah, and it's a really good point you make. You walk into that branch and you'll talk to Frank Lunchbox, who's the head of lending. And Frank Lunchbox, he has his own KPIs, and he has his own. All right, well, I've got to be pushing this product as opposed to that product. There are triggers and blocks and all kinds of things that's going on internally with that bank. That will motivate Frank Lunchbox to offer this product to a consumer who is who's unaware. And most consumers are unaware about what type of product is best for them and what are the features of that product. And whereas the mortgage broker and there's a reason why banks aren't doing financial planning anymore, and that's well advertised on why they're not, is because of this sort of thing, favouring this investment and corralling consumers into that direction as opposed to maybe they should be going in that direction, because I know if I give the bad advice as a branch manager, I'm protected under the legal umbrella of the bank,
That's true.
right? And so, I'm. Whereas if I'm a mortgage broker, it's just me. I've got to be as sharp as a tack. I've got to make sure I'm giving the best feedback, mortgage advice to my consumer, because not only if I don't, it's my license, but also I want that consumer happy, and I want that client, to be a life client. I want that person to come back to me for another refinance. I want that person to come back to buy their second property and to buy their car. I want them to refer their son and their daughter, their mum and their dad, their best mate at a barbecue. So I have got to deliver. I've got to give them the best product, and I've got to give them what they're looking for, and I've got to do it as cheap as possible. And I've got to be there on the phone with them whenever they need anything.
Yeah.
And there are like yourself, there are great brokers out there that do that.
Yeah, exactly. And then
And banks can't compete with that.
No, most definitely not. And they don't operate with the same responsible lending obligations that brokers have to. We are
Right.
we have credit licenses and we're credit reps, and we have obligations that we have to live by. They don't. You can be a banker and have no credit license and no credit rep and not have to operate under best interest duty or responsible lending. So they can do things which they shouldn't be doing. And obviously, I can't speak for everyone. But in terms of the debt negotiation industry, you mentioned earlier about licensing. Is there actually a specific license for debt negotiation that consumers or even business owners as well need to be asking when they're calling around?
Yep, there is now. If they don't have a license, don't deal with them. That's critical, because there's a reason why they don't have a debt management or debt intermediary license with ASIC, is because they didn't pass.
Okay.
And there'd be a reason for that. ASIC didn't pass them to have a license, and that's fairly recent in the last 4 years. We've had a credit license since 2009, because not that we needed it, but we felt that because we work with financial specialists like planners and accountants and brokers. Not only should you got to be not only doing the right thing, but you've got to be seen to be doing the right thing. And so we've been open to any kind of ASIC audit since then. We've never been audited, which is great. Hopefully we never will. But anyway, but we've just having a license has built our credibility within the finance industry. And only in the last 4 years, but there are many, many more negotiators. Some of them just kind of starting out without any experience at all, and not delivering great. So there've been so many complaints about this industry that ASICs just put their foot down and said, right, we're going to put a license requirement, and you've got to be compliant to this process now, which is great news. And so we had to transition our existing license that we had for 10 years over to the debt management license. So they've got to have a debt management license. There'd be issued with a license number, so you'll know it. So you just ask about that and maybe do some research on their background to help you make a decision on whether to deal with them or not.
Yeah, and for the listeners that do want to connect with you and your team, what's the best way they can find you and do their research about you? Even.
Yeah, Google reviews are really good. Have a look at the Google reviews of because they're hard to fake.
Yeah.
Though it's not foolproof. So you can look at Google reviews, but just go on Google in general, put the company name and put in complaint, and see if there's any Google notation or any public record around any complaints. You can have a look on the ASIC website to see if there's any issues with that company with ASIC. But ASIC is playing catch up with a lot of these companies as well. So there's ongoing audits to some of these companies, but there's still some cowboys out there. It's still a little bit Wild Westy. It has a Wild Westy feel, our industry, and so it's all the more critical to do your homework and to see if there's any complaints about that company. Put the company director's name in to Google and see if there's any history. So there's a couple of agencies out there that I'm aware of. I won't mention who they are, but they're running successful companies, but their previous companies have been shut down because of the number of complaints and ASIC cracking down on them. And so, but you can track them through the director's name. You can see what history is with them. So, but ultimately, the best way to do it, after you've done all that, give them a call.
Yeah.
Have a chat with them. Find out what the costs are. And ask them questions around the costs, the credit reporting, and the ongoing obligation. And do your sums, get your calculator out, and work out whether this is going to be a good deal for you or not.
Yeah, that's really good advice.
And upfront. Are they charging money upfront?
Yeah, and what for? Like, are they that confident on their service that they can, as you said, be incentivized to get the result, not sort of say, "Oh, I've already been paid. It doesn't matter whether I get the result or not."
Well, yeah, but in saying that, there's a couple of good negotiators I know, and they say, well, we have to charge up front because of the administrational costs.
Yeah.
And that's just their business model, and that's fine. I mean, they'll charge, like, say, if they know the deal, it's going to cost about the client about $8,000 to waive a significant amount of money. They might say, all right, well, we'll need $1,000 up front. Okay. It may be refundable if we're not successful, or it's a non-refundable, whether we're successful or not. It's non-refundable because that just covers, and there's a lot of administration behind doing this kind of thing, a lot, and it's top heavy on it. So if they charge something like that, that of itself doesn't mean that they're shonks.
Yeah.
But it just keep that in mind, right? So I know there's a couple of very, very good operators who do it that way, and that's just their model that they work with.
Yeah, no, it's a really good point. Right? At the end of the day, you don't want to also waste people's time. Like if they're putting all these resources and dedicating time and doing the administration, and it doesn't go ahead, that's obviously no revenue, just time for nothing. And I just had a quick search. So your company is called Credit Mediation Service Proprietary Limited.
Yep.
Is that the one? Northwest. Is that the one? Yep. So you've got 100 Google reviews, all 5-star. Exactly 100. It's impressive.
Oh, except one. Is a 4-star. One of them's a 4-star, and the rest are 5 stars.
Okay, 4's still pretty good, but that's pretty impressive. Like you would think. I think if you looked up other mediation services, there'd be some negative reviews there. So that's a red flag for sure. But don't just base it off of that, right?
Yeah, there's some good ones out there who have got pretty good 5-star reviews. And truth be told, it's really hard getting to that level because like I'm in financial trouble and it gets fixed for me and I'm a little bit embarrassed about it, right? And understandably, I would be. And then I'm asked to give a Google review. That's a public declaration that I've been, I've had some challenges with my finances and I've got someone to fix it. So most people don't do a Google review for that reason.
Yes, that's a really good
point. The fact
we've
got 100 is great. Yeah, it's great. But there's 10 times that we've assisted.
Yeah, you're right. It's going publicly.
Which is understandable.
Yeah, really good. Yeah. So my question before we wrap it up, I wanted to ask you about your TEDx talk. I saw that you did a TEDx talk. Can you share a little bit about that? So when the listeners want to watch that video, they can.
Okay, all right. So I'm got to get my head out of finance and into suicide. The two are kind of linked in some ways, but not so much in other ways. All right. So, Victor, the reason why I did this TEDx talk is because there, in our line of work in finance, you will often see people who are in a very dark place because they're needing to get through the difficult times that they're experiencing. And when they're going through those difficult times, they think about exit strategies, right? For a lack of a better term. Okay, so I've been working with Lifeline for 15 years, and I used to train Lifeline counsellors, new Lifeline counsellors on suicide training and mental health. And out of all the suicide calls I've taken, I don't think I've met anyone who wants their life to end, but they want their pain to end. That's the thing. They want their pain to end. They don't want their life to end. They're thinking about ending their life because they're dealing with their pain. And so what a suicide call is about is direct intervention to ensure that they're safe, and then dealing with the pain. And a counsellor and a psychologist will work on this pain that's pushing them towards the suicide. So with that TEDx talk, it was more about how it is that what lessons we can take from people to deal with those suicidal thoughts. Okay, so what lessons can we take? For example, so I'll just have to think about, because I did the TEDx talk about a year and a half ago, and I had to think about what what I said. So through when we're in this dark place and we are feeling like that we want this pain to end, what do I do? What kind of intervention do I need? And there's a number of things that I can do, but ultimately, what I think about is the time where I was at my happiest. So was at Oxford. I'm pretty sure it was Yale University. They'd been doing this long-running survey. They picked out over 100 young men who and gauged their mental health. Gave them the questionnaire. This was before World War II. And one of the participants was JFK, the President of the United States, but when he was a young man. And every few years, I think it was every 4 years, they'll touch base with them to see where their mental health is. And over the years, they've been doing that since the 30s. And some of those men are still alive today, very few of them, but they're still surveying them. And it's the longest running survey in history as far as we can tell. And one of the questions that they ask is, what makes you happy? And the answers to those questions like that, as you can imagine, are evolving. And ultimately, at the end of the day, what the survey has concluded is, the big question is, what makes us happy? And the ultimate answer on what makes us happy is to have people in our life who love us and we love them. That's ultimately what makes us happy, is the intimate connection that we have with another human being, be it husband, wife, be it brother, sister, mum and dad, and children. There's an ex-palliative care nurse, Bonnie. She wrote a book. She's an Australian nurse, and she spent many years in palliative care, caring for people at the last stages of her life and of their life. And she wrote a book on the 5 greatest regrets people have before they die. And ultimately, it's top of the list is, I wish I reached out to my loved ones more. I wish I spent more time with my friends. I wish I did the things that I wanted to do, like travel the world, horseback riding, live by the beach, or live in the country, or live in the city, wherever. I wish I fulfilled their goals. spent time with the people that they loved. They were the two top things. What wasn't on there was, I wish I spent more time in the office.
Yeah.
I wish I made more money. No, that wasn't on the list at all. And so the central feature of the TEDx talk, Victor, was the lessons that we learn from the dying and the suicides, people who are considering suicide. What life lessons can we learn from that to make us happier? And that is this. You think about a time in your life when you're at your most happiest. Think about when you're, going for a walk in the forest, or whether you're with your family at Christmas time, or whether you're, whether you're on the beach, or whether you're, etc., whatever, just fill the gap. And you think about that time, and you might not have that moment right now. You might be estranged from your family. You might be living away from the beach, or what have you. But you think about that time, and how is it that I can re-navigate myself back into that place again? How is it that I can do that? Or the best way I can that would shadow that place. Because my happiest time might be when I'm with my mum at Christmas time. My mum's passed, so I can't do that anymore. But how is it that I can have a shadow of that? And it might be with my immediate family. It might be with my children. It might be a close friendship. So how is it that I can almost relive those happiest times, but do it in context to my life today? Yeah. That's essentially the guts of my presentation through TEDx.
Yeah, look, thank you for sharing that. I know it's a dark topic, and I'm sure it's a lot of people have had some exposure to suicide, especially through COVID, or loved ones that they've lost through that. And it's interesting that earlier on, at the beginning of the interview, you mentioned that you used to do collections, and then you would also help people via Lifeline. And it's like you realize a correlation with being, somewhat of the cause of why people would consider suicide, because of the pain, the pressure that got created from all the debt that they were in. And when you're knocking on the door as a collection agent, you have to kind of put up an emotional wall, right? Because if you don't, you're at stake, and you're going to have empathy and not let them get away without paying back anything. So you found that bridge, yep, which is the debt negotiation. It's like now you can actually represent clients directly, not representing someone that wants the money from them, but actually help them solve the pain around debt. And like I said, my mum was in that. She nearly had a nervous breakdown. And by being able to alleviate that pain, not only are you getting them away from thoughts of suicide, but you're reuniting them with peace and harmony and love with their family, right? And their loved ones, because now that's no longer a burden between them, or creating a gap between them. Now you can bring them back together. So I just want to acknowledge you for that, and the good work that you're doing. And if I have clients that are in that situation, most definitely I'll be sending them your way.
Thanks, Victor. Thanks. It's good chatting.
Yeah, it's really, really good to have you on. I know we mentioned the name of your company, so if the listeners want to find you, if they want to connect with you on social media, are you active on the socials?
Not overly. I'm telling my age. I kind of get impatient with the whole social media thing, although I'm on LinkedIn. Probably the best way to reach out to us is via our website, w.creditmediation.com.au, or you can reach out to me directly, Hugo, Hugo, at creditmediation.com.au.
Awesome. Thanks, Laurence. And if anyone wants to watch his TEDx talk, you can just type in Laurence Hugo into YouTube or Google and have a watch of that. So really appreciate your time. Thanks again. And thanks for everyone that's supporting the show, and keep following and sharing and liking anyone who you think can benefit from this. And I'll see you in the next episode.
All right.
Cheers.
Thanks, Victor. Take care, mate. See ya.